without wasting too much of time, let me come straight to the topic, which is a match between Islamic finance and Fiqhul Malia. So what I understand from this topic is that we have had some introduction of what do we mean by Fiqhul Malia, what are the important components that come in Fiqhul Mamlia, Fiqhul Mamlat, and then Fiqhul Malia is a component, is a subcomponent of Fiqhul Mamlat. Then how do we apply those principles in Fiqhul Malia in Islamic finance? When we develop instruments, financial instruments in Islamic finance, when we execute transactions, different transactions in Islamic finance, then how do we use the principles in Fiqhul Malia to conduct our business operations, financing operations in Islamic finance? So first of all, let us briefly recall what are the different principles that govern the Islamic finance, or you can say Fiqhul Malia in Islamic finance. So first of all, Islamic principles emphasize on ethics and values, and these things are governed by rules as well. For instance, when we talk about consumption and when we talk about enterprise by firms, there is a distinction of what is halal and what is not halal. So it is emphasized that when we are consuming as consumer, or when we are producing and supplying goods and services as firms, as suppliers, we have to ensure that we engage in transactions which involve halal goods and services, halal commodities, halal subject matter. So that is very important. And secondly, there is emphasis on justice, fairness, and transparency. So it's not just enough that we engage in halal transactions, but then do not abide by the rules of justice, the rules of fairness, the rules of transparency. So Islamic finance is not just prohibiting one or two elements. It is all encompassive, and it's ethical and values based system governs a lot of things, not just what are the different types of commodities. So the emphasis is there on justice, on fairness, and on transparency as well. After that, it is also emphasized that we have to avoid fraud, deceit, and exploitation in economic exchange. Then, after we have discussed certain rules which govern the economic exchange in Islamic finance, there are certain other principles which emphasize the conduct of excellence through moral persuasion. So there is encouragement to go beyond halal towards excellence. So we know that there are certain transactions which are halal, but then there are certain other ways that we can achieve excellence, the best halal, the ideal halal. And there is emphasis on charitable behavior. So it's not just that we engage in economic activities and exhaust our all resources. The Islamic principles emphasize that if we have surplus resources, the best way is to use them for the needs of the society. So there is emphasis on charitable behavior. Yes, there is no compulsion that every surplus resource that we have has to be spent on social needs, but the excellence is to do that. So there is, you can say, two sets of principles that govern Islamic behavior in Islamic finance. One is the set of rules which have to be followed in true spirit, in true letter. And then there are certain principles which have the element of moral persuasion. So there is encouragement towards going for excellence, even though this is not made compulsory, but the ideal is that we go towards excellence. And then there are reminders about our role as trustee, and having this feeling in our hearts that there is a secondary right of poorer segments of society in wealth. So this is in a nutshell what Islamic principles ask us to do, or you can say that these are the principles which are emphasized in the Islamic sources of knowledge, which includes Quran and Sunnah, which guide our economic behavior and which should govern our economic behavior in the markets. Now, if we come to more specific points which pertain to Islamic finance, there is a set of principles which prohibit certain elements like riba, gharar, maisar, and then there are certain principles which emphasize that if we want to engage in a productive enterprise and we want to earn some resources for ourselves, through market exchange, then the reward has to be risk based. There is uh, uh, allowance to have reward in economic activities, through economic activities in marketplace, but it has to be a risk based reward. So one reason why riba is prohibited is that it's not a risk based reward. It's just simply a guaranteed amount of profit that a person gets by just simply loaning out money. Islam does not consider it as a commercial contract. Islam says that when you provide loan to a person, it's not a commercial contract. It's just a non-commercial contract where you should not be expecting any reward out of loaning out the surplus money that you have. So Islam says that there is no return on money loans, no financial return of any kind on money loans. When we provide loan as money to someone, then we cannot expect any financial return because this is not a commercial contract in Islamic finance. And then there are also principles which govern the redistribution of resources. So Islamic finance is not just about doing banking and finance just the way conventional banking and finance operates. Islamic finance also incorporates other elements which emphasize on redistribution of resources. So Islamic social finance include institutions like zakat and waqf, through which we have wealth transfer in the Islamic economic framework. Now, this is just the broad, you can say, principles that we come across in Islamic finance. Now, drilling down to further details, when we talk about economic exchange can be in the form of doing trading. Economic exchange could be in the form of leasing a particular asset. Economic relationships could also involve partnerships. So Islamic principles are applicable in all of these different kinds of economic exchanges or economic relationships. So when we talk about trade, trade involves two parties, buyer and seller. So there are certain rules which govern sale in Islamic finance. Uh, so all rules of sale pertaining to Islamic principles of trade must be followed whenever we are doing a trade transaction. All rules of sale have to be followed, and these include that the subject matter of sale needs to be halal. The subject matter that is being traded, it has to exist. Now, there are certain exceptions to this rule, like in the form of salam and istisna. Salam and istisna are two exceptional sales where it is allowed that even if the asset does not exist, we can do trade in those assets. But generally speaking, when we talk about a trade transaction, a sale transaction, the subject matter has to be existing at the time of sale. The subject matter has to be valuable as well. So if we just simply sell, let's say, air or fire or a stone which does not have any value, so the trade would only be for those goods where we have a valuable asset. If an asset is a common property resource, then it is going to be used by everyone. Like everyone enjoys sunshine, everyone enjoys oxygen. It's a common property resource. There is no market exchange involved in that. So when a sale is involved, the asset has to be valuable, existing, halal. And an important point is that if someone is selling an asset, the seller has to own the asset, has to have possession of the asset, and has to bear the risk of the asset which he or she is selling. Now, when we apply it to contemporary markets, especially financial markets, we come across certain transactions like short selling, where you sell an asset which you do not own, which you do not have possession of. So these kinds of sales are not allowed, because when we apply the principles of Fiqhul Malia to contemporary financial transactions, we have to see that the rules which have been emphasized upon in Fiqhul Malia, they have to be applied in contemporary financial transactions. If we see that there is a mismatch, there is a contradiction, there is something which is not being followed precisely, then we would say that such a transaction would not be considered as halal, would not be considered as permissible in Islamic finance. So we go from principles to the application, and then we have the ruling for different financial transactions, different financial instruments. Some other rules of sale include that the sale price must be determined without any ambiguity. So if we say that if payment is done with 1 month lapse, this would be the price. If payment is done with 2 months lapse, this would be the price. We cannot have such a sale contract. In the sale contract, it is necessary that the sale price has to be determined with a particular time frame of payment. So it is allowed that the price could be different across time and space, but once we are conducting a sale, it has to be determined. The price has to be determined. It cannot be made ambiguous. It cannot be made conditional. And another important aspect of a sale transaction is that it must not be conditional. If there is some condition which is within the norms of business, then this can be admissible. But otherwise, making two contracts combined in one, or making one sale conditional on some other event is not permissible. And there is a economic merit for these rules as well, because we have seen that if we have lots of such contingent contracts, what happens is that there is speculation in the market, there is um, volatility in the market, and which can disrupt the price discovery mechanism, and which can also cause asset bubbles and financial crisis, as we have been witnessing in the last 2 or 3 decades. Now, when we come to rules of lease, in economic exchange does not just involve a spot transaction. It is also possible that sometimes we cannot buy a particular fixed asset because it is very highly priced. So what we can do, we can lease that asset. Sometimes we can include a financial institution and we can go for financial lease. Now, the problem with conventional financial lease is that it involves riba. So we cannot use conventional finance lease. But in Islamic finance, we have ijara-based mode of finance, which is an alternative to conventional finance lease, and which is different from conventional financial lease. So in the rules of lease, especially when we are talking about Islamic finance, these rules have to be followed. There are other rules as well, but these are the major ones, that you cannot lease every asset. The asset which can be leased is a non-consumable asset. So for instance, you cannot lease something like food stuff, because it's a consumable asset. When you will use it, that asset, that commodity will lose its form, will lose its existence, and then you cannot give the same commodity to the person from whom you got that asset or commodity in the first place. So only non-consumable assets are rentable, which do not lose form existent during the process of use of those commodities or assets. And when rent is charged, it is important that rent can only be charged after the asset is transferred in usable condition by the lessor to the lessee. If asset is not transferred in usable condition, then rent cannot be charged. So if, let's say, a car is booked, it has not been possessed by the owner. So the owner cannot lease that car to someone else and then start charging the rents until or unless the asset is transferred in the usable condition to the person who was asking for that asset on lease. So only when the asset is transferred in usable condition, the rent can be charged. And for the periods in which the asset remains unusable, rent cannot be charged. Rent can only be charged for the periods in which the asset remains usable. And the entity who is charging the rent has to have ownership of the asset and bear risk of that asset. If the owner is a different person, if the risk is not with the person who is charging the rents, then this is not allowed. Now, these are the Islamic rules of lease, which make Islamic lease or ijara different from a conventional finance lease. In conventional finance lease, one or a combination of these elements are absent. So why we say conventional finance lease is not permissible, and why we say that ijara mode of financing for long-term financing is permissible, it's because we apply different rules of Fiqhul Malia to different kinds of financial transactions that we come across. And then we see that are the transactions following Fiqhul Malia, the rules of Fiqhul Malia. If not, then we have to modify those transactions, structure them in a way so that they are compliant with the principles which are laid down in Fiqhul Malia, and then we can have a legitimate Islamic finance product or a transaction using that particular product structure. Now, coming to other kinds of economic exchange or relationships. We come across partnerships of few persons, partnership of few firms. We can have a joint stock company. So these are the different ways to financing is sought. So one important way of financing is equity financing. Corporate form of business organization basically uses equity financing to form a joint stock company. Now, when we talk about rules of partnership in Islamic finance or Fiqhul Malia, it is important that profit for any partner is not fixed, because if it is fixed, then we are giving guaranteed return on capital investment to a particular partner, and that would make it very much like riba. So that is not allowed. Profit cannot be fixed in terms of amount or as a percentage of capital. It cannot be done. So we cannot have someone investing, let's say, 100,000 rupees and is given this guarantee that you would get 10,000 rupees of profit on your investment every year, or you would get 10% profit of your capital investment. We cannot provide such guarantees in Islamic equity based financing or Islamic partnership. Likewise, profit sharing has to be done as per profit sharing ratio, and the profit sharing ratio has to be applied to the actual profit side, not to the capital. It has to be applied to the actual profit side. So if the profit sharing ratio is 60-40 or 70-30, it would be applied to the actual profit side, which can be very high, very low, which can be positive, which can be negative, and it does not really fix profit for any partner. So profit sharing mechanism has to be such that it is not fixing profit for any partner. It is allowing profit sharing, but based on a profit sharing ratio that is applied to the actual profits that are earned in the partnership. And when we engage in economic relationship of sourcing funds through partnership, then that partnership would engage in further economic exchanges like producing goods and services and then selling them, or producing goods and services and then leasing them. So it has to be ensured that the profits that the partnership earns has to be earned in halal ways, meaning that the partnership business has to abide by all the principles that we have studied in Fiqhul Malia, and which includes the rules of sale, which includes the rules of lease, which includes prohibition of other elements like gharar, maisar. All of these things have to be avoided. The don'ts have to be avoided, and what has to be included for the profits to be considered legitimate in Islamic finance. Now, if we briefly just summarize what are the Islamic modes of financing, we can classify them under three heads: sale-based financing, lease-based financing, and equity-based financing. In equity-based financing, we have mudaraba and musharaka. The difference between the two is that in mudaraba, the capital comes only from rabul mal, only from the investing partner, whereas in musharaka, the capital could come from many partners. And in both the equity financing contracts, the loss is shared based on the capital contribution ratio. So because in Mudaraba, only the investing partner contributes capital, so the financial loss is borne by only the Rabul Mal who is investing capital in the partnership. Whereas in Musharaka, there are different partners who share their capital, share their working and efforts for the partnership. If profit is earned, it is shared based on profit sharing ratio. If loss is incurred, then it is shared based on the capital contribution ratio. Now, sale-based and lease-based mode of financing are other ways through which financing can be sought. These are also considered as debt-based modes of financing. Why? Because in using these contracts as modes of financing, what happens is that the client eventually has a financial liability. So that is why they are considered as debt-based mode of financing. So sale-based modes of financing are usually used where sale of assets is involved and the financial need of the client is usually short to medium term. Whereas lease-based financing is used when the client's financial need is medium to long term. So when we have fixed assets which have useful life spanning over 5 years or 7 years or more than that, then we can go for lease-based mode of financing, but that also depends on the client's financial need. Now, in the next few slides, we will see some examples that Fiqhul Malia gives us a framework. in which we can then see that what are the different permissible things that can be done in a particular financial need. Then, based on the financial need of the clients or and of the counterparties involved, one or more of the permissible modes of financing can be used. Now, let me illustrate this point through an example. Now, this is an example. Are you able to see the right part of the slide? I'm not sure is it visible or not because of the screen. I think I will have to
It's visible to me.
minimize it. Okay, is it visible? Okay, it is visible to you. All right. So this is one example, and in the at the end of this example, it is asked that which modes of financing are allowed and which is more suitable. Now, which modes of financing are allowed would depend on what is permissible under Islamic Fiqhul Malia. Now, what is more suitable would depend on the financial and economic need of the client and of the counterparties who are involved in the transaction. Now, let's say there is a company, Falcon Cement, is looking to construct a new plant and for which it requires land. So there is a company which requires land. The company is unable to purchase the land from its given liquid resources right now. So it has a liquidity problem. It does not have enough resources to buy land for its new plant. It wants long-term financing. Now, this detail is important from the point of view of structuring financial transaction, keeping in view the economic and financial needs of the counterparties. Now, the company wants long-term financing where the financial cost per period is as small as possible in a given period. So the company wants long-term financing so that its cost of financing is not too much every period. So what happens is that when you are allowed to pay the price of asset over a long period of time in installments, so what happens is that your installment would become smaller. But if your period of financing is very short, then you have to pay the price of the asset in a short period of time. So your installments are going to be bigger. So the company wants long-term financing, and the reason why it wants long-term financing is because it wants to spread its financing cost over a longer period so that its burden of finance cost is not too high every period. So that the firm is able to manage financial burden with its given resources and liquidity. The company is also considering knocking the doors of capital market, but it has limited customer base and not a well-established name among the general public. The company desires to own the land eventually. That is also one aspect that we have to keep in view in suggesting what would be the better mode of financing in this case. The company is also concerned about future increase in land prices. So if it delays and then tries to accumulate more resources from its revenues to buy land eventually after some period of time, then it also fears that the land prices might increase. So it cannot wait for 5 years or 10 years to then buy land, because by then the land prices would have increased manifold. Hence, the firm is looking to have a middle way between purchasing land now and purchasing land in future. Purchasing now is not possible because the firm does not have money. Purchasing land all at once in future is also problematic because land prices may increase in future. Now, given this scenario, which modes of financing are allowed and which is more suitable? Now, when we talk about which modes of financing are allowed, uh, we can have ijara, we can have diminishing musharaka, but given this requirement, we have to see which is more suitable. Now, the company could also go to capital market and issue sukuk as well. That is also a possibility. And if, let's say, if it gets a partner, it might go for equity financing. Even trade-based mode of financing might be used with certain conditions. But the suitable mode of financing would take into account the financial and economic circumstances of the counterparties as involved as well. So here we see that the company wants to have long-term financing, so the lease-based mode of financing are more appropriate. And because the period of finance is going to be very long, and the price of the subject matter or the asset or the property which is going to be used in this transaction might have increased in price over a period of time. So it's better to keep on purchasing the land in installments, and also then be able to use the land during the period of financing. So in that case, diminishing musharaka seems to be more suitable mode of financing which can be used in this case. Now, you can definitely use Ijara as well. You can go for other modes of financing as well. But when we apply Fiqhul Malia to actual financial transactions, we have to see two things. One, that the mode of financing that is used has to be permissible in a particular transaction. And then we have to see whether it also fulfills the economic and financial need of the counterparties involved or not. So that is very important. Now, take another example. We have one company, let's say pizza makers, they want to purchase a heavy duty oven for their commercial operations. Now the oven cost is, let's say, $100,000 or rupees, whatever the price is. The price is this much if you pay on spot. The owner does not have that much money. So what he wants financing. Now he wants financing, but he expects to be able to pay the amount in a short period of time. Maybe because the owner is running a business which has a very stable sales volume, a stable revenue base, and it does not have any problem of not being able to generate enough revenues to pay the financing cost and so on. So if there is an existing business which has a customer base and which has a stable revenue base, it might not like to go for long-term financing and pay higher financial costs for a longer period. It might look for short-term financing. In that case, because there is a fixed asset involved, Ijara is also possible. But looking at the financial need that the client only wants short-term financing, credit nor any payment or delivery takes place, nothing takes place in spot, only there is a bilateral promise, a contract to conduct a sale transaction in future. Such transactions are not allowed. Yes, there is a alternative that you can have a unilateral promise, a based transaction, but a bilateral obligation would make it a contract, and then the contract, if it is not executed, if the sale contract is not executed in spot, it is not allowed. That is why conventional forward or futures contract have problem. What about options? Options are derivative contracts which give right to buy or sell an asset. Now, in Islam, promise is not a subject matter of sale. You cannot sell promises. You cannot make a trade in promises. So, if you make a promise, it is not going to be a subject matter of sale. You cannot have a consideration against the promise. Secondly, if option price, call price or put price is considered as partial payment of price, then the problem is that the sale may be executed, may not be executed. So in option, you only have an option to buy or sell. You may exercise that option, you may not exercise that option. So if you do not exercise that option, then we cannot regard call price or put price as the partial payment of price of the asset which is being sold, because it is not sold eventually if the option is not exercised. So there is an element of gharar involved as well in options. So that is why conventional options are not permissible. What about swaps? In contemporary finance, what happens is that sometimes uh, there is a need for going for floating rate financing versus fixed rate financing, or vice versa. So in contemporary finance, sometimes firms or even financial institutions want to swap their fixed rate liability with a floating rate liability, or a floating rate liability with a fixed rate liability. Now the problem with that is that if we are having an assignment of debt, it can only be at par value. It cannot be at different values. And if, let's say, the debt itself is not Islamically permissible, let's say a person has taken financial lease from a bank at fixed rate. Another person has taken financial lease from a bank at floating rate. Now, if they want to swap, there are two problems. One is that debt assignment at different values. The other is that the debt itself is not created Islamically or is compliant with Islamic principles. So that is why swaps are conventional swaps are also problematic. What about certificate of deposits, which financial institutions offer to customers as well as to financial institutions as well, special investment deposits? So these instruments also involve element of riba, because if there is a stipulated return on a loan, then it constitutes riba. So through these examples, what I've tried to explain is that whenever we come across a financial transaction or a financial instrument, we have to break it down into into its structural elements, and then see what is happening. And then we have to compare it against the principles that we have studied or are studying in Fiqhul Malia. Then we have to see whether the Fiqhul Malia principles are followed in letter and spirit or not. If not, then we say that that financial transaction or the financial instrument is not permissible until or unless that particular element which is causing the problem is removed, is replaced, is restructured differently. Then we can have a Islamic alternative. So when we look for match between Islamic finance and Fiqhul Malia, my understanding is that first of all, we need to have a very good grasp of what is Fiqhul Malia. And then we also need to see what are the different financial transactions and financial contracts and financial instruments that we come across in contemporary times. And then we have to make a comparison and see how these principles are applied or misapplied or not applied. And then we can form an opinion, which definitely only the Sharia advisors are well versed to make when they do this comparison through a very careful study of the rules of Fiqh Malia and also the contemporary finance. And then we can have a clear picture as to what is permissible and what is not, and what has to be done to make a particular transaction permissible. So in Islamic finance, the emphasis is that Islamic rules of um, finance, which includes the rules of sale, rules of lease, rules of partnership, and all the other elements, they have to be followed. And then the contemporary financial need can be met using different financial instruments in Islamic finance. So the financial or economic need is not haram as such. So if a person has a need to, let's say, preserve wealth, that financial need is not impermissible, but that need has to be served with a correct financial instrument, with a correct financial contract, which does not violate the principles in Fiqh Malia. So I end my talk